In 2025, the global economy defied expectations, showing surprising resilience despite rising trade tensions and policy uncertainty. The OECD, a key economic watchdog, has revised its forecasts upward, signaling that global commerce has adapted better than anticipated. Businesses acted preemptively against tariffs, and transformative technologies like AI became real drivers of growth. China's proactive fiscal policies also helped stabilize both its own economy and global demand. This adaptability has bought the world time, providing a buffer against the harshest outcomes of trade disputes. However, the OECD warns that this period of stability is only temporary. The underlying dangers remain. The lesson: economic forecasts can't always predict the ingenuity of businesses or the impact of targeted government action. The US's aggressive new trade policy in 2025, including a 10% floor tariff and further hikes, pushed tariffs to levels not seen since 1933. Many economists expected an immediate economic downturn, but the most severe impacts have been delayed. Large corporations initially absorbed tariff costs to maintain market share, shielding consumers from price hikes. This strategy created a temporary buffer, but as profit margins shrink, companies are now starting to pass costs on. The OECD warns that this absorption period is ending, and higher prices are beginning to ripple through the economy. The delayed impact of tariffs is now emerging, threatening consumer spending, investment, and jobs. The true effects of these policies will define the economic climate of 2026. The calm was only temporary. The storm is approaching. Businesses worldwide responded to looming US tariffs with a massive front-loading effort, rushing goods into the country before new duties hit. This surge boosted global manufacturing and shipping, temporarily inflating GDP figures in early 2025. However, front-loading simply pulled future demand into the present, creating an artificial boom. Now, as inventories fill and tariffs take effect, orders are declining and industrial production is slowing. The OECD highlights this as a key reason for both the current resilience and the projected slowdown. The economic strength of early 2025 was borrowed from the future, and that debt is now coming due. The unwinding of front-loading is exposing the true cost of trade barriers. Beyond front-loading, two forces have driven more sustainable growth: booming AI investment in the US and major fiscal stimulus in China. AI is now a real economic engine, creating jobs, boosting productivity, and offsetting slowdowns in other sectors. China's government spending on infrastructure and industry has stabilized its economy and supported global demand. These actions have had global spillover effects, propping up commodity prices and supply chains. The combined force of America's AI boom and China's fiscal push has kept the global economy moving forward. Yet both are subject to change. China's stimulus may fade, and AI investment could slow. These engines have bought time, but can't guarantee lasting growth. The OECD now forecasts global GDP growth at 3.2% for 2025, up from 2.9%. A testament to the economy's unexpected resilience. This upward revision signals that, despite ongoing global uncertainties, the world economy is showing a surprising ability to adapt and recover. The increase in the forecast reflects not just statistical adjustments, but a real sense of optimism among economists and market watchers. This upgrade reflects the temporary boost from front-loading, AI investment, and China's stimulus. Major economies are leveraging new technologies and policy measures to drive short-term growth, with artificial intelligence and digital transformation playing a key role. China's targeted stimulus has also helped stabilize global supply chains and trade flows, providing a much-needed lift. However, growth is already moderating compared to 2024's 3.3%, and headwinds like high interest rates and inflation persist. Central banks remain cautious, keeping monetary policy tight to combat inflation, which continues to erode purchasing power in many regions. Businesses and consumers alike are feeling the pressure of these persistent challenges. The OECD projects a further slowdown to 2.9% in 2026 as temporary supports fade and tariffs bite deeper. As the effects of stimulus measures wear off and global trade tensions increase, the pace of expansion is expected to decelerate. Protectionist policies and supply chain disruptions could further dampen growth prospects. The 2025 figure marks a peak in the current cycle, a moment of stability before a likely slowdown. For now, the global economy enjoys a period of relative calm, but this may be short-lived as underlying vulnerabilities remain. Policymakers and business leaders are urged to prepare for tougher times ahead. Strategic planning and proactive risk management will be essential to navigate the uncertainties that lie beyond this brief period of growth. The numbers tell a story of adaptation, but also warn of risks beneath the surface. While the data points to resilience, it also highlights the fragility of the recovery and the importance of vigilance. This resilience is real, but it may be fleeting. Without sustained reforms and continued innovation, the gains of 2025 could quickly unravel. The global economy is holding its ground, but faces a more arduous path forward. The coming years will test the adaptability and resolve of nations, businesses, and individuals alike. Despite the upgraded forecast, the OECD warns that significant risks still loom on the horizon, threatening to undermine the fragile progress made so far. The most pressing threat is the delayed impact of US tariffs. As companies begin to pass higher costs onto consumers, there's a real danger that household spending and business investment could falter, slowing economic momentum. Inflation remains stubbornly high, with G20 rates projected at 3.4% in 2025. If tariffs persist or new global shocks emerge, inflation could climb even further, eroding purchasing power and squeezing family budgets worldwide. Policy uncertainty is another major drag on growth. Businesses are increasingly hesitant to invest or expand, worried about the possibility of more tariffs, trade disputes, or sudden regulatory changes that could disrupt their plans. Meanwhile, slowdowns in key manufacturing nations like Germany, Brazil, and South Korea are clear warning signs. These countries are vital links in global supply chains, and their struggles point to weakening demand across the world. The unwinding of the front-loading boom, where companies rushed to stockpile goods ahead of tariffs, is already underway, threatening to stall the fragile recovery and leaving inventories bloated. If these negative trends intensify, the risk is that the world economy could tip from slow growth into outright stagnation or even a recession with widespread consequences. The global economy is walking a narrow and precarious path, vulnerable to persistent headwinds and sudden shocks that could easily knock it off course. The risks are real, the challenges are mounting, and the margin for error is shrinking with each passing month. The 2025 global growth story is one of contrasts, with each major economy charting its own unique path through a landscape shaped by shifting trade policies, technological innovation, and geopolitical uncertainty. The US, despite leading the tariff charge, is forecast to grow 1.8%, down from 2.8% in 2024, thanks to strong consumer demand and AI investment. While growth is slowing, the American economy remains resilient, with robust job creation and a thriving tech sector helping to offset the drag from higher interest rates and trade tensions. The US dollar's strength continues to attract global capital, even as inflation pressures persist. China, targeted by tariffs, is projected at 4.9% growth, buoyed by fiscal stimulus, but this is expected to moderate to 4.4% in 2026. The government's efforts to stabilize the property market and boost domestic consumption are showing results. Yet challenges remain as export demand softens and demographic shifts begin to weigh on long-term prospects. The Eurozone shows modest recovery at 1.2%, but remains vulnerable to global trade slowdowns, with growth set to dip further. High energy costs, persistent inflation, and political uncertainty continue to cloud the outlook, making it difficult for the region to regain its pre-pandemic momentum. Japan is steady at 1.1%, benefiting from tourism and domestic demand, but faces global headwinds, The weak yen is boosting exports and attracting visitors, yet an aging population and sluggish wage growth remain long-term hurdles for sustained expansion. Emerging markets like India, with a remarkable 6.7% growth rate, along with Brazil and Indonesia, are bright spots, increasingly driving global growth. These economies are benefiting from young populations, expanding middle classes, and rising investment in infrastructure and technology, positioning them as engines of future prosperity. The world is now multi-speed. Emerging economies are rising as traditional powers slow. This shift is reshaping global trade patterns, investment flows, and the balance of economic influence. Each region's outlook depends on how well it navigates trade, policy, and structural challenges. Success will hinge on adaptability, innovation, and the ability to respond to both external shocks and internal pressures. The global recovery is uneven and fragile, with risks and opportunities emerging side by side as the world economy enters a new era of transformation. The OECD spotlights growing concerns about the U.S. labor market and immigration policy. The Trump administration's crackdown on immigration and federal workforce cuts could create labor shortages, especially in tech. A dramatic hike in H-1B visa fees threatens the supply of skilled workers, alarming the AI and tech sectors. OECD economists warn that restricting skilled immigration risks a productivity slowdown and loss of U.S. competitiveness. The debate is now about securing the talent needed for economic success in the AI era. The future of U.S. innovation may hinge on resolving this conflict between political goals and economic necessity. The stakes for the labor market and the broader economy are high. Despite the risks, the OECD points to clear paths for stronger, more sustainable growth. De-escalating trade tensions, especially between the US and China, could unleash a wave of global confidence and investment. Accelerating AI adoption offers another major upside, with the potential for broad productivity gains. Governments must invest in digital infrastructure, education, and smart regulation to harness AI's benefits. Policies that attract skilled workers are essential for building dynamic, knowledge-based economies. The global economy stands at a crossroads. Resilience has bought time, but choices now will shape the future. By embracing freer trade, fostering innovation, and investing in people, policymakers can turn today's resilience into tomorrow's growth. The opportunity is there. If leaders act wisely, the world can build forward stronger than before.